Well, obviously, price tells you that they're losing control, but let's not even talk about price. We did mention that we're in a structural deficit. We've had a supply and demand deficit for 5 years, and that's what happens when you get a small a small market size wise as far as dollar amounts. I mean, the total production globally is only like $30 billion a year. But when you get a small market that's easy to manipulate, and if you're constantly manipulating to the downside and suppressing the price, what that does is it makes it much more difficult for producers to earn a profit, so they mine less silver. So, a direct consequence is the fact that we're in a structural supply deficit. Other things to look at, you can look at the lease rate on silver. You can look at the lease rate and the amount of shorts available on SLV, which is strictly paper. That's not actual physical silver.
The precious metals market is approaching a tipping point. Bill Holter's new analysis shows that this isn't a normal upswing. A deeper fundamental split indicates the paper market is losing its grip. Holter points to the constant warning signs before a system fails: rising lease rates, rising borrow rates, silver and gold backwardation, and a worldwide rush by sovereigns, institutions, and individual wealth to accumulate real metal. Market tone shifts when serious money chooses solid metal over paper promises. Traders no longer push contracts on displays. Buyers seeking the actual thing changes everything. Models crumble, forecasts fail, and the paper framework that's been stretched thin for decades can no longer pretend everything is all right. Holter doesn't underestimate the potential. The system has offered contracts against non-existent metal for years, but you can only play that game if no one collects. After one delivery failure or inventory deficiency, everything is exposed. Silver is at the heart of that fragility. Industrial demand and financial appeal dominate this modest market. Thus, the residual stock stacks are easily overwhelmed. Holter predicts a violent, chaotic squeeze where borrowed metal is recalled. Leasing charges skyrocket and prices climb so sharply and quickly that the charts can't process it. His interview contains a warning beyond market mechanics. Holter revisits the Great Taking, where financial problems lead governments to use anything they can: capital controls, wealth grabs, private ownership restrictions, or seizure. Whether you agree with his ending, the intermediate message is practical and real. The metal you hold, how you hold it, and where it sits could decide your wealth control in a crisis. Holter's advice is frank. Digital access, bank custody, and IOU-style certifications may not be available when needed. Keep reading as we discuss Holter's 3 key questions that any serious investor should consider. What's beneath the silver market? Whether the suppression methods are finally failing, and how to defend your purchasing power if governments use harsher tools. To avoid surprises, like, subscribe, and share if you're here for the whole story. Dive in.
Well, it's like gold was overbought. Silver was more overbought than it was in 1980, back at the peak. And what you've seen with both of them are high-level consolidations. The paper trade is waning and the physical market is growing. The physical markets are growing. Just look at what the BRICS are doing. I mean, they're opening storage facilities, refineries. They're very serious about accumulating both gold and silver. And it makes sense because, for years and years, they had, I guess the metaphor is tons. They had tons of dollars on their books, and now they're adding tons of real money on their balance sheet. Well, obviously, price tells you that they're losing control, but let's not even talk about price. We did mention that we're in a structural deficit. We've had a supply and demand deficit for 5 years, and that's what happens when you get a small market size-wise as far as dollar amounts. I mean, the total production globally is only like $30 billion a year. But when you get a small market that's easy to manipulate, and if you're constantly manipulating to the downside and suppressing the price, what that does is it makes it much more difficult for producers to earn a profit, so they mine less silver. So, a direct consequence is uh, the fact that we're in a structural supply deficit. Other things to look at, you can look at the lease rate on silver. You can look at
Mhm.
the lease rate and the amount of shorts available on SLV, which is strictly paper. That's not actual physical silver. But the rates to borrow, it's blowing the shorts. The shorts are being blown up. All that money is going to be pointed toward gold and silver. Those markets, I mean, especially silver being so small, they cannot handle the type of capital that's going to be heading the toward a safe haven or these safe havens. And one other aspect of man, fear is the greatest emotion there is. And people are going to be moving money into gold and silver, not out of greed because, I could buy gold at 50 and I can sell it at 100 or 200 or whatever. That's not going to be the motivator. The motivator is going to be fear of losing everything in other markets and putting that money into something that is a safe haven and cannot
Well,
bankrupt. That's the whole key. They can't bankrupt in a world that is defaulting. So they did try to ration what supply they had.
yeah, and that's like a very like that's just a fraction of the kind of scenario that we're kind of thinking up in our heads, because there's no real there was no danger of the fiat currencies are devaluing. You look at the the money supplies of the US dollar, the RMB, the euro, the Japanese yen, all of them. They're all going up at the same time, but there's no real imminent threat that your currency is going to be devalued to the point where you have to go out and spend whatever you have and procure the metals ASAP. But that was a very small sample of what was to come, and it was pretty big. Those lines were pretty big. Especially in Asia.
Well, the biggest lines you don't see, and I don't see. Nobody sees them. The biggest lines are the electronic lines.
Mm-hmm.
Once you get full-fledged movement from family offices, hedge funds, they're smelling blood in the water. Once we get to that point, it's going to make what we've already seen look like not even just barely a starter.
Yeah, and we're already starting to see crypto sell off. Bitcoin is down to 90,000 some odd dollars, but gold and silver have both held on fairly steadily. It appears that crypto is highly correlated to the Nasdaq, which is atypical of a safe haven asset like gold, and to a somewhat of an extent to silver as well. Silver does have some industrial usage too, but when I look at silver and I hear these arguments that silver is more industrial than monetary, but doesn't the fact that silver have utility kind of make it more valuable than gold, or the fact that silver has more utility than gold? Shouldn't that make it more valuable? Holding the supply side constant.
Yeah, well, silver's got many, many uses. It's not just industrial. You've got technological, you have medicinal. Go back hundreds of years. You remember the term, he was born with a silver spoon in his mouth. Well, only the wealthy people could afford silverware. And the reason they used silverware was because
Holter doesn't color his discussion of silver's industrial uses. He explains why silver operates differently from other currencies. Electronics, solar technology, medicine, and many manufacturing processes depend on silver. Many of these sectors can't curb demand during a crisis. Even as investors flee to safe haven assets, industries pull silver from the supply chain. Combine it with a long-standing production shortage. The world uses more silver than it produces. The inventories that may fill the gap have been depleted, melted, or exported. That creates a market where supply cannot respond rapidly to demand spikes. That's why silver's upside can explode. Industrial purchasers, investors, and sovereigns converge on a dwindling metal pool. If the paper market can no longer disguise that imbalance with synthetic supply, the price can change in ways the conventional models couldn't handle. Holter then warns against the financial system. He calls modern treasuries and banks over-leveraged machines that look stable until confidence fails. They can reprice to zero faster than expected when stressed. When that happens, governments use whatever tools they think would maintain power. Capital limits, excessive taxation disguised as policy, metal restrictions, or planned confiscation.
The antibacterial
Properties.
that properties of silver, right? Exactly. Gold is basically strictly money, and silver for several thousand years was also money, but it has other uses. It has more uses than any other element on the planet.
Yeah. Well, I also know that the fiat currencies are in trouble. We've looked at money supply on this channel before. Money supply, not just in the U.S., but across all the other currencies is going up. But you also have something else that's going up, and that is something you just brought to my attention before we hit record, and that is the Japanese 30-year yield. I mean, check this bad boy out. Currently at 3.337%. Well, this is an all-time high in the Japanese 30-year yield. So why is this something to keep an eye on, Bill?
You want to keep an eye on the Japanese interest rates and also the Japanese yen, because that is it's the bed, if you will, for the carry trade. The carry trade that had been put on. They were doing this back in the 90s, early 2000s. You could borrow in yen at low interest rates, and you could just turn around and buy U.S. Treasuries and make the spread, and that's fine as long as interest rates don't rise in Japan, and it's fine as long as the yen itself does not rise in value versus the dollar. It was a cheap way of funding, and it's being shut off. Not only is it being shut off, but it's turning some of these carry trades upside down because the rate to carry is higher and the cost to buy the Japanese yen back is higher. So the carry trades are blowing up. That's what that chart is showing you. In my opinion, look at the debt to GDP level in Japan. They're at what, 300% or thereabouts.
Oof.
And you go back into the 1970s and early 80s. I remember when I was in college in the early 80s, any country that got to 100% debt to GDP, they were opening the door to Banana Republic land. And now there's hardly any countries around the world that are under 100% debt to GDP. The U.S., the issuer of the world's reserve currency, is at 130%. Back in 1980, the United States would have been considered a banana republic. And actually, as an aside, if you look at the rule of law and the things that are happening in the United States, there's an argument we are a banana republic. Understand this: the casino itself is bankrupting. So what you need to do is you need to cash your chips in now, get those chips out of the casino and out of chips. You got to convert your chips into something real, and that's basically, you need to convert your fiat currencies to gold and silver, because the analogy of the casino being bankrupt, you've got sovereign treasuries all over the world that are upside down.
Now, there's many different roads to take when it comes to converting and allocating your capital into gold and silver. I know you're big into junk silver as a means, as kind of like a means to do so. Why is that? And I know you have some stuff that you want to talk about junk silver on. Why is junk silver?
Yeah, and this is
the way to go, in your opinion?
This is for non-IRAs. In an IRA, you've got to do a product that's 99.9 pure. Mm-hmm. Junk silver, I've been an advocate of junk silver for the last 10 plus years now. It's the smallest denomination of silver. In other words, 14 dimes equals 1 ounce. I think it's $1.38 equals 1 ounce. So that gives you 14 transactions in a system down scenario. If you're going to barter, now you've got the smallest unit of silver. It's recognizable because everybody knows what a dime or quarter looks like. And as long as it says 1964 or earlier, you know it's 90% silver. It can't be counterfeited because if somebody comes to you with a bright, shiny, brand new dime or quarter, it's probably fake because junk circulated for years and years and years. It was in people's pockets. It should be scratched. It should be dirty. And on top of that, it is U.S. mint lineage coin. Now, the reason I wanted to talk today about junk is because the pricing on junk versus other forms of silver have temporarily collapsed. I think dealers are bidding $4 and $5 under spot if you go to sell it, and you can buy it at spot, maybe 25, 50 cents over spot. It's the cheapest form of silver available right now.
Holter concludes with resilience-focused real-world steps. He advises investors to change a significant amount of their fiat assets into flexible real metal. Pre-1965 U.S. coins, basic government-struck silver coins, and low-premium rounds offer possibilities when electronic payments fail or barter becomes common. These smaller pieces are tougher to fake, easier to trade, and provide the transaction range you need under unexpected settings. Another key point is custody. Holter advises that putting all your metal in banking institutions or pooled inventory exposes you to the problems you're attempting to avoid. He favors personal possession, private vaulting, and secure storage outside your jurisdiction. Knowing the legal nature of each option and avoiding paper claims on pools that may disappear as the system strains are crucial. Holter advises investors to think beyond metal stacking. As additions to bullion, he recommends junk silver, official coins, and industrial-linked pieces. He emphasizes preparation. Document your assets, preserve clear records, and arrange for multi-jurisdictional liquidity. He doesn't consider this theory. Difference between wealth on paper and wealth you can utilize when it counts. Holter concludes by focusing on market indications. Lease rate increases, backwardation, ETF inventory declines, refinery backlogs, and sovereign accumulation. These signals indicate the paper market's inability to conceal shortages. Adding geopolitical concerns and supply chain interruptions to those signals makes a silver and gold squeeze likely. Holter's conclusion is apparent. Acting after official confirmation is too late. In case today's analysis helped you see the big picture, like, subscribe, and press the bell to stay updated. Thanks for watching. Be vigilant, prepared, and safeguard what you can while you can.